John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, John Ulzheimer here. Today I'm going to talk about credit card APRs relative to the APRs of other forms of credit. So the question that I got that gave me the idea for this particular topic was from a consumer who had applied for a retail store credit card, and they were approved for the card, and they were a little bit surprised, I think a little bit shell-shocked as to the APR. The APR was almost 24%. It was like 23.9 some odd percent. And she was like, why is this so high? And she's got really good credit, right? She couldn't understand why she was getting such a high APR on a retail store credit card for someone who has good credit, because her comment is that, look, everything I've ever seen about credit reporting and credit scoring is that they're influential to the APRs that you get on anything, auto loans, mortgages, credit cards, etc. Does that not apply here? And it's a reasonable question because you would expect a really good APR for someone who's got a really good credit report and credit score. So let's talk about credit card APRs specifically. So what is the APR? APR is the annual percentage rate. Some people just call it the interest rate. Basically, it's the amount of money you're going to spend to service the debt if you have any, meaning if you carry a balance month to month, it's the cost of doing that. And by the way, this doesn't apply just to retail store credit cards. This applies to general use credit cards like your Visas and MasterCards and whatnot. The APRs of those at any given time on average are about 17%. And so again, that's a really high APR for someone who's got good credit, but that seems like to be what we all get. So those types of interest rates are multiple times higher than what you're going to pay for an auto loan, and multiple times higher than what you're going to pay for a mortgage for someone who's got, good credit and equal credit. So the question is, wait a minute, how can I get a 3.25% APR or interest rate on a mortgage lown, and I'm getting a 24% interest rate on a retail store credit card? What jives it? So here's the deal. It's the type of loan. It's the type of credit that's being extended that is really what's influential here. Credit cards are, most of them anyways, are what's called unsecured, which means that if you default on credit card debt, the lender can't come take back anything. Okay, they can't come get dinner, they can't come get the clothes you bought, they can't come get the gas that you put in your gas tank with your credit card. They can't do any of that stuff. So it's a really risky extension of credit because it's unsecured. There's no collateral for the extension of credit. And so because of that, they have to actually charge more for everybody to subsidize the risk of being in that business. Where if you are, for example, a mortgage lender or an auto lender, you can afford as the lender to charge a much lower interest rate because people don't want to lose their cars and people don't want to lose their homes to foreclosure and repossession. And so those types of loans that are secured are more stable and they default at a lower rate than credit cards. There's also an issue of how much you lose as a lender for a default on a credit card. If I were to go open a credit card today and to say I got a card with a $25,000 limit and I maxed it out and I never made one payment, the bank would at the very least lose $25,000. If I borrow money on a home and I default on the home loan, they're going to come take the home through the foreclosure process. They're going to sell the house and they're going to take whatever the proceeds they were able to get from the sale of the house and apply that against the loan amount. And so there is the ability for secured lenders to offset the amount that they lose for loans, whereby for credit cards there is not an opportunity to offset the amount that you're going to lose. So the amount you lose on a bad for a credit card is a very, very big deal, which is again why it's a riskier extension of credit and why lenders have to charge more because if you want to be in that business, it's a risky business to be in. So that's really why credit card APRs are going to be much higher than other types of APRs, and there's really not much of an exception. So how do you get around that? It's actually pretty simple. Pay your balance in full every month. If you pay your balance in full every single month, then the APR of your credit card is immaterial because you're not applying an interest rate to any balance because there is no balance. That's the way around it. I have no idea what any of my APRs are in any of my cards because I don't care. I pay my balances in full every month, excessively use my credit cards, and therefore my interest rates are meaningless and for entertainment purposes only because I don't pay interest. So if you have any other questions about APRs, drop them in the comments section below. And thanks for watching. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.